Good day, everyone, and welcome to the Pinnacle Partners State of the Opportunity Zone program and an update on our Pinnacle Multifamily Fund of Four. Very pleased to be with all of you, and thank you for joining us. We have a star-studded panel assembled for you today. We will be covering today's program, a primer on the OZ program, the tax benefits that are associated with that. We will talk about Pinnacle's execution, truly an early mover in the program, why we invest in opportunity zones and very specifically multifamily real estate. We will talk about the real estate fund landscape in great detail, and I think we've got a really unique insight associated with that. And the state of the program and the proposed legislation to expand and potentially extend the tax benefits. And then we'll conclude with and really reveal the Pinnacle Fund of Four, all four projects seated in the portfolio, and we'll very quickly review those four specific projects. I'm really pleased to be joined today by two of the real architects of the program, which was enacted 5 years ago. The first individual I'd like to introduce is Sandy Persant from Greenberg Traurig. They happen to be our legal counsel. Sandy was on the real estate roundtable as policy was being enacted 5 years ago. Sandy has been quite active in the OZ space, probably helped to structure the top OZ funds. And I think it's the statistics are over 100 real estate funds in total and 500 joint venture agreements. So he is steeped in experience. He recently authored a paper which was published by the Institute of Federal Taxation on QOZ Primer and 2022 Hot Topics, and has been published, I think, Sandy, each of the last 4 decades. Is that correct?
That's right. It was my grandfather that was publishing those, though.
That's right. So we're really pleased to have Sandy join us today. Also joining us is John Scheretti. John is a partner at Novogradac. Novogradac is probably the leader in tax and accounting support for federal credit programs. John is really specialized in the opportunity zone incentives, is our auditor of record, and is quite expert in all the various incentives, and is influencing policy through his work as chairman for the Novogradac Opportunity Zone Working Group. So John, thank you for joining us today.
My pleasure. Thank you.
And then, of course, my partner, Leo Backer, co-founder of Pinnacle Partners, brings to bear his 36 years of real estate experience, all facets of the industry, and he will lead the review of our portfolio, which we've been very busy sourcing the highest quality projects in the country, and we think put together one of the most attractive diversified portfolios in the OZ space. So I know we've got almost a couple hundred attendees. Many have been possibly participating in the program for some time, and many are new to the program. So let's review the incentives. And this is particularly topical. We're, again, pleased to be with you today because alternative assets, those not necessarily representative of the stock market, are increasingly attractive. And real estate in particular has been known to be an inflationary hedge, so an attractive asset class at this time. And now the opportunity zone tax benefits coupled with real estate investing are indeed compelling. And in fact, as John will suggest in his portion, opportunity zone investing is on the rise. It has amounted to close to, I think, $30 billion of capital invested. And the economic effect of that is probably 7 or 10 times the amount of capital invested. But let's start with the primer. Again, the program has been enacted for 5+ years. We, Pinnacle, have aggregated close to 200 million of capital gains. I think our investors are very happy they're participating in the program at this time because they've enjoyed the following benefits. The first is when they transacted and realized a capital gain, either short or long term, they were able to defer the tax associated with that transaction or that gain through 2026. So we look at that as kind of interest-free loan from the IRS to use that money to invest in a real estate project as an example. Real estate is an attractive, tax-efficient asset class, as I mentioned, increasingly attractive given current turbulent times in the stock market. And depreciation can be used in opportunity zone real estate investments as a further tax shield for income produced through the project. And there is no recapture of that depreciation as there is in other real estate transactions because of the third and final benefit of the Opportunity Zone program, and that is the permanent tax exclusion. So after a holding period of 10 years, all the appreciation in the real estate becomes tax exempt. In other words, when we trade to sell the asset, there is no capital gains tax associated with that transaction. And that is very, very powerful. So these are extremely attractive tax benefits that are applied to Opportunity Zone real estate investing. And so we, Pinnacle, we are an early mover, and we'd like to consider ourselves a pioneer with our two colleagues here on the panel, investing very early in 2018 when the regs were relatively ambiguous. Again, now 5 years forward, the market has matured and attracted an immense amount of capital. We believe it's the most compelling tax shield ever enacted in US history. I think that is a fact. Real estate has been an attractive alternative asset investment. Again, when there is very little correlation with the stock market, and in particular during these inflationary times proves to be a good hedge because you can mark to market, particularly in multifamily, your rental income each and every year, i.e. increase rents. So that's why we focused exclusively on multifamily. There's a variety of asset classes or product types within the real estate market. Could be retail or hospitality or office, but we've chosen to take advantage of the massive secular need for housing and to deliver new generally ground up construction, new housing stock to the market at this time. And remember, we are holding these assets for 10 years. And so we think we are quite resilient to the kind of economic cycles we're experiencing today and we will experience tomorrow. And during the investment period, we can generate NOI, quarterly distributions of income, return on capital. It's a very tax efficient asset class. And then when added to the OZ benefits, the tax benefits, the aforementioned benefits, it's extremely compelling. And so again, this marketplace was enacted by the 2017 Tax Reform Act, in place now for 5+ years. Sandy, as I mentioned, has been on the ground as an early architect of the policy and then transacting in this industry, the OZ industry, with many of the leading funds, including ourselves. And I think he's got a unique perspective on, one, broadly speaking, real estate in the macro, but also the OZ marketplace. So Sandy, please continue and give us your point of view.
Okay, so I think first, thanks, Jeff. I think first I'm going to tell a little story about how this started and how I got involved in this at the beginning of 2018 with my partner, Jim Lang, having me fill up a room where I didn't want to go because I had no interest in low-income housing credits, that kind of thing. It just wasn't my thing, okay? And then I found out that this is completely a different program. These opportunity zone investments are real estate development joint ventures. All of them are. They have a developer, they have capital source. Sometimes it's one family, same thing. You can do your own co-op, or you can go to the professionals who lived with this, like Leo and Jeff that we're seeing it on the screen. So it's 2017. Sean Parker, founder of Napster, big guy in Facebook also. He comes up with the idea that we need to revitalize Oakland. So they wanted to start the next Facebook in Oakland, and how would you incentivize people to do that? Well, you'd incentivize them by this program. And this program would let people roll capital gains into it and direct it where the government wanted it to go, into these opportunity zones. Move the capital there by giving a great tax incentive. So people would take money out of the stock market, recognize the capital gain, defer the capital gain until 2026 in this program. They had some discounts involved. John will get back into that in a little bit because it looks like they're going to be revived in the new bill. So 5 and 10% discounts off your gain, and then permanent exclusion of the gross. And then we find out that also depreciation, which would cause you more gain, that's also exempt. So what you have here is like a Roth IRA where you're allowed to defer gain and you never pay tax on it. Okay, it's wild if you hold it for 10 years. Okay, so who jumped in? Not the business people to start it in Oakland when it started, but the people who jumped in were the real estate industry, because we've been living with tax benefits forever. Okay, and these are tax benefits that don't require low-income housing, et cetera. But what we've got in our projects here is the community benefit that they're looking for. Okay. So my partner, Jim Lang, was involved in this with John Shreddy very early in the program. And he comes out and he says, please come in and just hear about the program. Well, my jaw hit the table when I was done, because I had never seen this in 40 years of practice. And to tell you, I've been a partner at Ernst & Young running their global fund program, been a partner in the major law firms. And I have to tell you, we've never seen anything like this. And why it's so amazing is because the federal government is behind the program. Okay, we had Dan Kowalski in Treasury, who wrote most of the regs. Instead of the normal butting heads with Treasury, here because everybody wanted it to happen and the administration wanted it to happen, and it was bipartisan, they just gave us what we needed to do the industry. It took 3 sets of regs, took 2 years, took work by guys like John Shreddy and Jim Lang behind the scenes, both of whom, by the way, have been voted in the top 25 OZ influencers in the business. And we got through the regs. The first PPMs that came out said, we're not taking any money because there's no regs. Okay, but we want to tell you what we're doing. And here's our pros who are going to be running the real estate. Guys like Leo and Jeff. Okay. And that's what we did. And then the first set of regs came. And then we commented through the real estate roundtable, et cetera. Second set of regs, third set of regs. And now we have a real business. Okay. You can invest through big, massive funds that are unidentified, or you can go to the bespoke funds like we have at Pinnacle here with the folks, where the teamwork is there. You got experienced developer. The projects you're getting into. They're all in major markets. You got Austin, Denver, Nashville, Phoenix, all major markets, all growth markets. It's just a very exciting thing. But remember, it's a real estate investment first and foremost. Okay. And what we're seeing out there in the industry is that people have raised money and they didn't know what to do with it, and they don't know how to deploy it, unlike the folks that we're dealing with here. Okay, 2 ways you can do it. We've had 300 some deployments of opportunity zone stuff in our firm. We have, I don't know, 20 people that have touched it, and Jim Lang leads it, on the tax side, and it's very tight. Okay, the key thing though is to have a team. Because this is such a tax benefit, it's really important that it be structured correctly. It's important that the working capital plan that we got, matches reality and keeps getting updated. So it's a real partnership that has to be in any one of these investments. And it's a partnership between guys like John, your accountant, who's the most tax accountant, who's the most important person, because if they're not comfortable with it, it doesn't get on the tax return. So we have the leader in that. And then your lawyers, of course. I'm the fund obstetrician or the JV obstetrician in this case. And we have joint ventures with leading developers. And these leading developers, there are protections for the investors in the joint ventures. There are protections for investors in the advisory boards that we have. We have two advisory boards. We'll talk about that later in this fund. And just between the advisors, which would include your administrator, your fund administrator, who's going to track all this stuff, it's just a real team. You got to be careful with the rules. You got to plan for the future. And that's the way it works. Now, what's happening in the industry? A lot of consolidation in the industry. Okay. We're seeing a lot of people just aren't able to do the development projects. They're not able to do it on the time frame that they need, and they're just not there. We're seeing some of those assets come across the table. We are seeing the industry really pushing. There's bills out there. John's going to describe in a moment. There's bills out there that are going to extend the program. We fully expect them to be enacted. The projects that we have are going to be untouched by this program, except the fact that we may have to do some additional reporting, etc. So what do you have out there? You have the combination for success that you really need are the strong capital raisers, fund managers who can handle the capital. Number two, fund managers who can handle being strong in joint ventures with operators and are able to pick up should anything fall out of line, right? And you have to think about downside too. And you have the perfect team of professionals surrounding them and being the Kevlar that everybody needs, the investors and the sponsors. So these are successful. And so John, could you maybe let's move to talk about the program and what's happening with the program, how it's evolving?
Sure. Thanks, Sandy.
Sure.
So yeah, as Jeff and Sandy said, we at Novogradac got involved very early in the process, actually even before the legislation was introduced. We actually had the benefit of seeing draft bills and comment in a small circle, and we were pretty surprised that it actually was embedded in the Tax Cuts and Jobs Act in 2017. And as you've already heard, it took a couple years to ramp up, which is not unusual with a tax incentive. As you're waiting for rules around the legislation, and we were very involved in that process. I lead our Opportunity Zones Working Group, and we had an open dialogue with IRS and Treasury, and what we wanted to see in these regs to give comfort to folks to invest and feel like they could earn this tax incentive. And we did all that through our working group, which both Jeff and Sandy are members, so they were involved in that process as well. There's still some things that we would like to see in the regs, and we continue to try to get some guidance around certain things, primarily around how operating businesses work in this space. But for the most part, we were pretty pleased with the final regs. We also very early realized there wasn't a whole lot of reporting around the program, or at least no requirement to report other than through tax returns. And so that sort of usually lags the marketplace. So we started a fundraising survey, where we actually do direct surveys to a number of the qualified opportunity funds in the marketplace. We're up to like 1,400 funds. And we also get some information through the public marketplace funds that are public with the SEC and the like. Through this survey, we've had over 1,000, I think it's like 1,100 funds that have given us fundraising data to date. And as of June of 2022, that number is 30 billion. So Jeff said 30 billion has been raised in the program, but we think that we're only about 25% of the marketplace. There's a lot of captive funds out there that obviously we don't know or aren't able to get information on. And then there were some other studies done early on with actual tax return data. And, again, it lags. So it was sort of 2019. So looking at sort of that other fundraising data that was sort of a short time frame and what we think we have in the marketplace, we're pretty confident that there's over $100 billion raised in this program. So it's been well received by investors. And I think it makes sense, as we talked about the benefits. When we look at this, depending on the projects, when you look at the tax incentives, it adds 300 to 500 basis points to your investment. And so it's a nice incentive, and it works really well with real estate. Most of that 30 billion, you know, we have data around what sort of class of assets and where, you know, where the assets are that are invested in. And it's primarily real estate, and primarily residential real estate sort of leads the pack. So that's where the marketplace is today.
Got it. And John, what do you see in terms of the prospects for extending the bill, extending that 2026 date?
So there's a proposed bill out there now, and you know, there was a lot of discussion on the, I guess, well, let me go back. The original bill had reporting in it, and because that bill went through the Tax Cuts and Jobs Act, and that was went through reconciliation. And so because reconciliation has to be revenue neutral, the reporting, which costs money, was stripped out of the bill. So it was always intended for there to be reporting around this incentive. And it makes sense, right? Just so we can understand how well it's doing and how, you know, how well, or what sort of investments are being made and how they're improving the areas. And so that was stripped out. And then, you know, there was some tracks that were picked. The way this worked in the beginning is that governors had the flexibility to pick 25% of their low-income census tracts and designate them opportunity zones. And so, you know, it happened pretty quick. There wasn't a lot of time for folks probably to get all their ducks in a row. And some tracks were picked that may have already been kind of on the upswing. And, you know, it is a disadvantaged community type targeted investment. And so some of these areas were way on the upswing, and they got some bad press early in the leg. So that was one thing that, you know, I think both sides of the aisle thought, you know, needed changed, as well as the fact that, you know, it took 2 years to ramp this up. And so it's finite. It ends, the program today ends in 2026. And so, you know, because it took 2 years for the momentum to get going, you know, folks thought, hey, it'd be nice to have another 2 years on the backside of this. And so there's a bipartisan, bicameral legislation proposed. The sponsors are Senator Cory Booker and Senator Scott, and you know, along with co-sponsors from both sides of the aisle. And what this legislation does is it extends the tax incentive for 2 years, so to 2028. It also reinstates what was in the original legislation, this sort of partial forgiveness. And so you invest your gains and you get a deferral until that, and you would get a deferral into 2026 under today's rule. Well, if you held your investment for 5 years, you didn't have to pay, you only had to pay 90% of that original capital gain tax. And if it was held for 7 years, then another 5% was tacked on that. So you'd be paying 85% of your original gain. And that's how that worked. Well, now that we have less than 5 years until the program sunsets, nobody can get the benefit of these, what I call partial forgiveness benefit of the program. And so this reinstates that and actually makes the 7-year term a 6-year term. And so if it would have passed this year and you invested this year, you could get all 15%. We expect that, you know, that can be massaged a bit to give folks the ability to you know, get the full 15%. So those dates may be changed once we understand the timing of when this bill passes. It also,
Where do you think, John, when do you think that might be, the passage of this bill?
So it's bipartisan, bicameral. We think there's a really good chance that it could be inserted into some sort of tax extenders package. That, you know, there's a history of a tax extenders package passing even in a lame duck session. So it could be as early as November this year, and that's what we're hopeful for. And if not, it may, you know, carry over until the first quarter of next year. But it seems like, you know, again, it's bipartisan, bicameral, and so, you know, and it has some heavy hitters, sponsors, and so we're hopeful that, you know, we see it by the first quarter of next year.
So if I may, John, I just want to tie Sandy's presentation, your presentation together. So we heard about the genesis of the program, early days, it's kind of 17 Tax Act through 18, ambiguous legislation, then further refined after 3 passes. Now everyone, we're executing in 18, other funds are doing the same. But as now John suggests, there was a bit of a startup there. And so now this legislation, which was proposed maybe 2 months ago and before the House and the Senate, is likely, we're optimistic to pass. I want to demystify a couple things. The reporting requirements are on us, the fund manager, not on the individual investor. The individual investor is benefited by the fact that this is self-administration. This is simply one, I think it's Form 8940, John would know, that you attach to your return and you schedule your gain and your OZ investment, and that's it. You have just complied and now enjoy the associated tax benefits that we discussed. So this is not on the investor, this is more on fund managers like ourselves. That's correct, John, you agree?
I do. There are some investor reporting, but nothing more extensive than what's in the tax return currently when you look at the bill. So you do have, as an investor, when you defer your gain, you do have to sort of tell them what fund you invested in.
Right.
And so, it's not cumbersome at all. Actually, all the reporting is not that cumbersome. The really only real addition is some impact numbers that actually come from the projects in the fund, is responsible for.
So John, we have a number of our investors, again, we've been at this since, the early days, who may have invested in vintage kind of 2019 or even 18 projects. Would they be a benefactor of the extension, particularly on the deferral?
That's correct. So it's not tranched. It's anyone who's invested would get this sort of 2-year extension, and also the reinstatement of the 15% partial forgiveness that I talked about.
So if you had invested last year when the 10% was still available, you'd now enjoy the 15% step up?
That's correct.
Okay. Now this is major. That's why we call it OZ 2.0. Already $100 billion program. Again, the economic effects could be 7 or 10 times that amount. The extension here is a real boon, I think, for existing investors and attractive for net new investors that might consider this program. I'm going to launch a poll, if I may. If you could just, if the audience could just respond to this. If you're managing a capital gain, are you interested in the program? Are you going to evaluate this as a tax shield? Maybe accomplishing some diversification objectives that you may have. We're getting some good results here. Thank you.
While we're waiting for the results, just a word about the reporting and the impact reporting. What they're really concerned about are jobs and economic impact in the zones themselves. Okay, so I think we already pay attention to local hiring mandates, have people from around the surrounding area working on our projects and working in them down the road. So that's what's going to be required to be reported principally.
That's right.
Yeah, so that's what,
very good.
That's what the business is.
We're available. Q&A is stacking up, and we'll return to that in a moment. And so I want to talk about really a case study in the execution of the program. Let's move to Leo now, who will talk about this curated fund to four. We started out, again, I don't want to foreshadow, Leo, some time ago to build a differentiated fund and really take full advantage of the OZ program. So Leo.
Thank you, Jeff, and thanks everybody for joining. Yeah, I think originally when we were doing this webinar, it was going to be more about, Sandy and John talking about, what's happened in the OZ space and what we think is coming down, hopefully at the end of the year with this extension. And we do have a webinar coming up next month, which will be more detailed about our portfolio. But very quickly, so, Pinnacle started by funding single asset projects. We've now funded 10 QOZB projects in Washington and California, over 1,500 units of workforce and market rate housing, student housing, 2 adaptive reuse projects, So as Jeff mentioned, we were early movers in the OZ space. We used what we know of as the best, legal and tax counsel in our market to help us set up those projects. And frankly, it was a couple of our largest investors really prompted us by saying, well, we really like what you're doing and how you're sourcing projects, but we really would like to see a diversified portfolio that we could invest in one fund in multiple projects outside of Washington, California, primarily, because they're overly invested there already. And that's really what started here. And the first thing we did, first thing we did with Pinnacle is hire Sandy Heffernan, our CFO, who's the lifeblood of our company, because reporting and investor outreach is everything, right? And back office. In the OZ world, as Sandy mentioned, tax and of course you would say legal are critical, and structuring is everything. And we kept hearing about Sandy Person as the go-to fund, attorney. So we hired the best of the best. And same thing with Novogradac. We'd already worked with them on some of our projects. And when we look at real estate projects, you heard a lot about opportunity zones. My role and our partner, Jill Homan, who will be on our next webinar, Jill and I are really in charge of sourcing projects, underwriting the projects with our experts, and then executing on our JV plans. We really don't even look at the OZ benefits at all. All of our underwriting is without the OZs, and we look at the experts to make sure we're structuring the right way and keeping our investors' investments sound. But we look at the real estate on its own. And what we set off to do was to look at some of the top markets in the country to have a diversified portfolio of multifamily assets, a fund of 4, about 120 million of equity. That was our goal that we launched last December. We wanted to be the most fund-friendly, LP-friendly fund. And with Sandy's help, we think we set that up. We wanted to be very transparent to our LPs. And I'm going to be somewhat short in our review of our projects because Jill and I are available for reviews directly to investors to go over our portfolio. We did not want to be a blind pool fund. There are a lot of the aggregators out there, funds that are raising hundreds of millions of dollars. And Sandy, I like what you said, we're a bespoke fund. We didn't want to be, we wanted to raise equity for 4 projects of size and scale that we knew we could execute on. And right when we launched the fund in December and January, we had our first project locked in and closed our second project. And today we're proud to announce we have all 4 projects identified and closing our JVs on the final 2 to get to our fund of 4. So we are really focused in, market rate, single family, and now you'll hear build to rent is also a product type that we're very interested in and have one project for our portfolio. We looked at, no surprise, growth markets around the country where there's employment growth, people are moving for quality of life, and then where your wages, high wages to cost of real estate. So focusing throughout the Southeast, mountain states, and the Southwest were markets we were focused in. You see here on the map, the markets we looked at. Jill and I looked at, I bet you we looked at over 100 projects. We probably underwrote maybe 25 to 30 projects to get to the 4 projects now that we're locking in for the fund. So again, we like to be at major employers close by, universities close by. We like urban markets, and you'll see in the last 2 projects why we think maybe more suburban markets make sense in today's economy. And the perfect story for us is if a developer already owns a property or has a property tied up and didn't even know it was an opportunity zone. I bet you 80% of our projects, the developer didn't even know it was an opportunity zone. Which is a perfect story for us because again, we don't look at the benefits of the OZs other than that's the equity we bring to the project and we structure it that way. So the 4 markets that we are locked into, Denver, we had early on, I think early last year, we went and had our JV formed with Mortensen Development. Proud to announce we just closed on land yesterday on that project. We didn't have to close on land for about 9 months since we put together our partnership. And we've been working, Jill and I closely, Jill more than I, on design, and all, aspects of the development. We play a very active role with our joint venture partners, more than just bringing in equity. Sandy and their team helps us on all structuring of our JVs, and Jill and our analyst Wynn are really helping on the initial underwriting, and then really Jill's more oversight on, unit mix. She's even doing colors and designs of amenity spaces. So we really are truly, like an institutional partner for these developers. Mortensen Construction is a 57-year-old general construction company based in the Midwest. They've been in Denver for, I think, since 1981. So very strong in Denver. Their development manager has a lot of multifamily experience. This project is 200 units of multifamily podium product right next to the Denver Broncos Stadium in the Sun Valley neighborhood. Close to downtown, it's on the Platte River. There's another OZ project that's going to be built a couple blocks from us, which we like because it's a new upcoming neighborhood that's adjacent to downtown and the stadium district. So we think there's a lot of upside, for this marketplace. And we will have our building permits in December or January and break ground in February for that project. The second project is in Nashville. And, there's been a lot of news about Nashville over the last couple of years, a lot of growth. And frankly, as soon as we see, news like that, our radar's up, right? We don't want to be just in the same markets because everybody else is. But we met a sponsor. Jill knew this sponsor, Stillwater Capital, out of Dallas, and they hired a development manager that had been developing in Nashville for a number of years. And he sourced this site adjacent to the Titans Stadium. So no surprise, a lot of these stadium districts have industrial zones around them that are now being, looked at for, other types of uses, such as multifamily. This East Bank neighborhood is adjacent to downtown, right on the river. It's literally 5 minutes from Oracle's new major campus there with over 8,500 employees. This is also a mid-rise wrap product of about 375 units. And this developer is based in Dallas, and this is their first project here in Nashville for this development team, but their development partner has built many projects in Nashville, and they're emulating a project that was very successful in Dallas that they're bringing to the submarket. Both of these projects are what I would call market rate. We don't like to invest in high-rise premium units. It's more affordable market rate units for these cities. And I think this submarket will be, less than downtown. So people that are working at Oracle, people that want to walk to the stadium district, and close to the entertainment districts, this neighborhood is really going to be taking off. Now, these next two projects are our newest projects. We have term sheets executed for both, and joint venture documents are being drafted as we speak. And what's changed a little bit for us in our underwriting is it's getting very difficult to pencil market rate, mid-rise, and certainly high-rise projects in this market with construction costs and with interest rate environment and with rental rates kind of leveling out in some markets. We're being very careful on kind of what was our next third and fourth project. And we are, again, very fortunate to get introduced to a developer, another one out of Dallas, who had a site in Austin, Texas. And this is a site, a 12-acre site that they had already acquired off market to build garden style multifamily. And we think garden style is, it's very hard to find in opportunity zones that are close to urban areas because the land is too expensive. But in Austin, this particular site is about 15 minutes from downtown, 10 minutes from the airport, very close to Tesla's kind of mega complex there and Oracle. And it's a very large 350 unit garden style community. And again,
why don't you define garden style?
Garden style is surface parked.
Yeah, so you don't excavate.
So you don't have any excavation. You're typically 3 or 4 story max. And again, you're not building any structured parking. So it really kind of de-risks the entire construction process, both faster to deliver, less unknowns in the dirt. And the other thing is a diversification of product type, because these are now where most of our multifamily units are studios, 1 bedrooms, and some 2 bedrooms. These are primarily 1 bedrooms, 2 bedrooms, and 3 bedrooms that families are moving into from the smaller units. There's a big move from people wanting to be urban to be suburban, but close to downtown, because more people are working from home. They want amenities. So we're seeing a big push for people to move, to the suburban markets. This project, again, they own the land. We're in the design phase currently, and the plan is to break ground second or third quarter next year. And then the final project, Jeff and I and Jill were in Phoenix last 2 weeks ago, I believe, for an OZ conference. And we were introduced to a developer who has a lot of development experience, but they're a new group really going after the build for rent space. And we were very impressed with this group initially about kind of their delivery system and what they were focused in. But this particular market in Phoenix is 15 minutes from downtown and 5 minutes from Glendale, where their football stadium is located. It's a higher end suburban community that happened to be an opportunity zone. This is one of those stories that they didn't even know it was an opportunity zone. And they are really focused on, the single family for rent and townhomes for rent in this community. So this will be about 144 units. Again, they already own the land, and we're in the permit phase to basically do the site work early next year. And then we'll be going vertical, late next year, early the following for this, this product type, which again, garden style, we think is the continuum from, this mid-rise urban product and the single family build for rent with where the housing prices are today and interest rates, we think is going to be also the next boom for development. And we really like that in those Z markets that are, again, can stand on their own.
So just if I may, to clarify, so build to rent, or AKA BTR, is a very hot product type, particularly in this inflationary cycle where the cost to own a home and the mortgage associated with it now is, I think, ticked above 7%. And so this is for a young family desirous of both the space and a community and close to schools, but not able to afford ownership at the moment. These homes are being built for rent, not for sale.
That's correct. They're built for rent. And then, as in any, investment, you need to have an exit strategy, right? Because we're holding these for 10 years and there is a large market today, and we think will continue for institutions and private equity funds that are looking to acquire these assets. So you really want to have scale. So a project like this, it's not too different than a garden style community. They're looking for a rental product of scale that they can aggregate. So that's really what Jill and I have been working on heavily the last, several months, is this particular product type, because we think it really does de-risk the portfolio to have this different mix of uses, within our project, 4 projects.
So just in summary, Leo, as you mentioned, kind of hundreds, 100 plus deals reviewed and underwritten, or reviewed, I should say, 25 vetted and underwritten. The result now is this fund to 4 boutique, or bespoke, as Sandy called it, fund that's got a unique balance of product type and something we can execute on, and we think quite effectively.
Yeah, and I think the other thing, Jill and I are available to discuss kind of our internal process. We have an extremely astute advisory board. CFO of one of the largest multifamily developers in the country is on our board, and Jill, is very conservative in her underwriting, and she has brought me along to be that way. I mean, we don't take a sponsor developer's underwriting and call that gospel. So we get our own market rents from our advisory board. Avenue 5 Residential is a large property management firm, so we use their rents that they believe are market. We grow rents and expenses very conservatively. We look at the interest rate environment and where we think it's going, and same thing with cap rates. So we're very conservative, and sometimes too conservative. So we bring in our advisory board to really look at our underwriting, along the way, and they have done that for this portfolio.
Leo, can I speak to the advisory board for 1 second? Because it's kind of unique with you folks. Okay, everybody or most of these funds have an investor advisory board comprised just of investors to deal with the general partner when there's any issues that come up. They can deal with this advisory board, and your lead investors have already been appointed to that, so you have them looking over your shoulder. Secondly, though, the advisory board you're talking about is the GP advisory board that you guys created, that's paid for by you guys out of your share of the deal. It's paid for by you guys, and it's leading industry experts on the management and development side who are there as paid advisors to you folks to expand the team and get other points of view. So that's very unique with you folks. That GP advisory board.
Yeah, and that really kind of comes from Jeff's kind of technology background. I mean, putting together the best in class advisory board and helping, execute a business plan is new to real estate. And it's been critical for us, really, for growing Pinnacle, not only for sourcing of projects, helping underwrite projects. And we will continue with that model. You're right.
And you ate the cost of the board, despite my
it
telling
comes out of our,
you should have made it a partnership cost or a fund cost.
Yep.
So that's very generous of you folks, and wise. I mean, it shows your attitude, I think, as a sponsor, which is very unique.
So at this point, we've talked about, again, the genesis of the program, the specific benefits, the possibility of extension of those benefits, our execution of the legislation as it's reflected by our fund of four, this boutique fund. And we heard about the size and scope of the program, eclipsing 100 billion and all the economic benefits associated with that. So we're coming to conclusion now, but we are stacking up a number of questions. Let me just launch a final poll question, if I may. Don't know. Nope, can't do that. So I will not launch that particular poll, but we are getting a variety of questions. The first one, John, you referred to the OZ tracks, some, maybe not at this time, meeting the criteria for low income, need for development, et cetera. So with the proposed legislation, do you expect any OZ tracks to be disqualified? And how would that affect any investment that's already taken place?
Yeah, so the proposed legislation, so a low income track's 80% AMI, okay? The proposed legislation says that anything that's in that 130% AMI over that is going to be discontinued as an opportunity zone. So there's it's a big spread from what the definition of low income community is. As far as the transition period, if you've already invested, if you have actually if you've actually spent money on a project, I think it's like $250,000 is the limit. Or even if you mention the project in some sort of SEC filing or similar filing, then it meets the transition rules where it still would be a good investment. So there's not a whole lot of risk, of good investments going bad.
Good. Okay, thank you.
Nobody's talking about disqualifying anything that's underway.
That's correct. And underway is a very flexible
Sounds like
definition.
$250,000 invested. Thank you,
Yeah.
John and Sandy. Leo, question for you. How do you navigate the high interest rate environment? How do we?
Yeah, it's a good question. I mean, I guess the first and foremost, it's extremely critical as ever to be working with strong sponsors. Sponsors that have strong balance sheets, that have banking relationships. We're closing on our loan in Denver, and it was a very, very good loan for the time, but part of it was because of Mortensen and their background, very large GC and developer, and they bring in a business relationship. And from what we're hearing is most banks today are lending to relationship clients, not so much for non-relationship. So that's one thing we're doing. We just passed on a project because we didn't think the sponsor was strong enough to bring a loan that was, compelling for the project. Second is bringing more equity to projects as long as it's accretive to the deal. So maybe where we were 60 to 70% loan to cost, we're now closer to 50 to 55% loan to cost. So you're getting more competitive debt, with less leverage. So that's really that, we're looking at markets again that we think, that we come in with upside, and, we're being very careful, right? Where a lot of rent growth, everybody's smart when interest rates were low and rents kept going up. So we're just being very careful in the markets we're going into that we think, yeah, they may slow down, but we think they're sustainable.
And let me just call out, if I may, that the debt that we're securing at this time is construction financing. That's a shorter term loan, typically 3 or 4 years amortization, clearly affected by the interest rate increases. But if we moderate downward, that's a hope and an assumption that when we're seeking permanent financing, those rates may be potentially lower. That would be after stabilization, after construction, stabilization, we'd seek permanent financing. Could be a different market, different rate environment for sure. Sandy, question for you, and I launched that poll. Thank you for answering. What kind of protections are in place for investors as you build these, particularly the subscription documents? These are Reg D securities offerings. Just maybe highlight 1 or 2 protections for investors in these funds.
Well, yeah, I mean, understand these funds consist of 2 parts. One part is the fund documents themselves, and those are documents that we have the standard protections for investors. Your investor advisory board that's in there. As I mentioned, there's also a GP advisory board that you guys eat the cost of that adds extra gravitas to you, whatever you choose to do, I mean, they're people that you can really talk it out with that care. So as opposed to just general, hey, the market's doing great, type of advice. So that's I think a real thing. The second part are your joint venture documents that you have with these operators, with these developers, these 4 developers that you have. Now, you have these are 100-page documents, and they're the best that we have in our stable that we offer. I mean, these are documents that have been penciled out by the biggest developers in the industry, et cetera. So we use those, and they give us lots of controls, lots of tying the developer to the budgets, to the business plan. If they're out of scope, out of plan, we have self-help remedies, and more importantly, we have self-help talent in you guys, because you've had such experience with this. And that's really important. This is not just a tax game. You guys know the business, and you really need to know the business. The people that we're seeing getting hurt. Jim Lang and I, as we run this here, we've done $10 billion of deployments. Okay, there are people at your end of the bell curve, and there are people at the other end of the bell curve that really don't know what they're doing, and we're finding a lot of that coming to market to us. Okay, to people like you. So those kind of protections I think are very important. Your teaming that you do with Novogradac, who's #1 in the industry. With us, we like to think we're there. Your administrator, your team yourself. So who manages the developer. Long answer, a lot of protection.
Good response. Thank you, Sandy. And if I may also offer, we self-imposed our own audit. We thought it was in the best interest of our investors. That audit is conducted by Novogradac. And then we do routine OZ compliance testing, which ensures that you enjoy all the tax benefits we all expect to earn over the holding period. John, there continues to be questions around the extension. So I just want to clarify, if I'll kind of frame it as a statement and you can just acknowledge. So if I'm already invested in an OZ, I'm going to get the uptick in, assuming I have either 10% or 0 step up in basis, I'm going to pick up now 15% on a prior investment and move my deferral of the tax to 2028. Is that a correct statement?
That's correct.
Thank you. And so if I'm a new investor to the program and the legislation's passed, I'm going to immediately qualify for deferral through 28, and then I'm going to get the 15% step up in basis. Is that correct?
That's correct.
Yeah. Okay.
Assuming it passes.
Jeff,
Assuming it passes.
The investor still has to be careful about the 180-day rule and getting.
Well, yeah, we haven't talked about the 180-day.
So you don't want to wait. You talk to your tax people.
Yeah.
Because you don't want to wait for the legislation if you got a timing problem.
Yep.
You have to invest within 180 days.
Right. And that's something we didn't discuss. but as I mentioned at the opening, you generate a gain short or long term. Thereafter, you have 180 days to invest in an opportunity zone to qualify for the tax benefits, not 181 days. And that's we hit that timestamp diligently each and every time with our investors. So thank you for reminding us.
And special rules when you get a K1 that can extend.
If you have a partnership.
K1 that can extend that a bit.
That's right.
We'll talk about that separately.
And if anyone has a complex transaction, we go to Novogradac to get a disposition, kind of a forensic review of that gain and get the best advice. So anyone can come to us on that subject. Leo, we're getting a question on the BTR category, built to rent. How does it compare to traditional multifamily in terms of, well, it says specific to OZs. So what we like, I'll just kind of offer a partial response. What we like about the BTR product is that the sponsor is already considering a holding period greater than 6 or 7 years. And, of course, we have a 10-year holding period. So there seems to be better alignment on the timing. But Leo, do you want to talk about how BTR compares to traditional multifamily, either, generally from a return perspective or in OZs?
Yeah, the return parameters, at least our underwriting to date for this project, for instance, is on par with our other projects. We do think there's potentially more upside, but just suffice it to say, we are solving for a net return to our LPs for the fund in general. And this is, right in par with those other investments. The one downside risk for this product type is that you could, as an exit strategy, sell off each individual home because they're all separate tax lots. So as I mentioned before, there are, funds and groups out there, there are REITs that are looking to acquire these projects at a certain time frame. And our goal would be to sell it after the 10-year horizon. But as a downside, if those investors aren't out there, you could sell these as individual homes as a worst case. So that's the only difference, where multifamily, you're selling the entire project. Here, you could sell one at a time, which would not be our business plan. It would just be a protection in case there wasn't a buyer there.
And I think on most of them, one second, Leo, on most of them lower rise type as opposed to multifamily, which is high rise and more difficult to develop.
Yeah, it is, some markets, and that's a good point, Sandy. I mean, I know we're on our time, but this particular submarket has a very high barrier of entry. And that's why we liked it. It's very hard to get permits in this market for build for rent homes. Phoenix in general, not so much. So that's why we were, a little bit, radar was up in Phoenix, because we've passed on a lot of projects there because you can continue to build as you go out and out. But yes, there's single family rental. There's townhome rental, which is under the build for rent. There are some 3 and 4 story kind of separate buildings that are built for rent. These will have separate garages, separate homes. So true single family and or townhome with their own garages.
So I do think at the top of the hour, let's put a wrap on this. And I want to thank Sandy and John for joining us. And I hope the audience sees that we really do have kind of blue chip expert practitioners around the table. We're always available for consultation. Pleased to announce that the fund to 4 is now fully identified and in the portfolio. If anyone wants to dive deep into the underwriting, look at the interest rate assumptions and vacancy rate assumptions, et cetera, that is what we do, full transparency and visibility into the underwriting. And then if there's any sort of legal structuring or tax related questions, come to us and we'll get to the experts here, John and Sandy for sure. And so I hope everyone's got some significant value from this presentation today. So thank you for your attention and your time.